Hey now, it is the Hot Wallet Podcast. I'm Scott McGregor at Scott Trades on Twitter. Get a pen, get some paper, and get ready to take notes because we are joined with 42 Macro's Darius Dale, and he is going to give us a macro masterclass.
From the bottom, ain't no half stepping. I'm the dog, I made it through so they don't ask questions. Long Beach, and it ain't no half repping. Once a dog, always a dog, so they don't ask questions.
Okay, let's go. Darius Dale is the founder and CEO of 42 Macro, an investment research firm that aims to disrupt the financial services industry by democratizing institutional-grade macro risk management frameworks and processes. Prior to founding 42 Macro, Darius was a managing director and partner at Hedgeye and joined the firm after graduating from Yale. Darius, thanks for making the time for me today, man. I've been a big fan of yours for years. I thought the work you did over at Hedgeye was good, but I think what you're doing now is even better. So congratulations on all your success, and thanks again for making time for me today.
It's a real pleasure. It's an honor to be here, Scott, man. We just continue to grind and continue to get better and evolve, man. That's all you can do in this industry.
Definitely. So my first question, Darius, is what the hell is going on in markets right now?
That is the loaded question of loaded questions, my friends. So if I can be sort of quick and we can unpack any of this, there's a lot of different cross currents. I think, you mentioned one phrase that I think is very important to kind of spend some time unpacking, which is macro risk management. Macro is kind of, anything that could tick, anything that could shock the economy or asset markets. But from a macro risk management perspective, macro risk management takes all those sort of big things, that wide umbrella, and distills it down to the first principles, the core things that actually matter most in terms of, determining the sector and style factor dispersion within asset markets, determining dispersion across asset markets, and ultimately kind of the returns investors are feeling in their portfolio. So answering your question, what is happening from a macro risk management perspective, there's sort of four big things that matter. There's the growth cycle, there's the inflation cycle, there's the liquidity cycle, and then there's the positioning associated with all of that. Right now, we're in a cyclical slowdown from a growth perspective. That cyclical slowdown is likely to start to sort of speed up, if you will. So things will start to get worse at a faster pace. That our model suggests that's likely a 2H22 event. Right now, we're still very much in a positive inflation impulse. Our models continue to support or see inflation momentum continuing to build, particularly in some of the more stickier parts of the inflation spectrum. And so that's likely to continue to have us in a very adverse consequence from a liquidity cycle perspective. Fed withdrawing balance sheet support, Fed hiking rates, and not just the Fed, but we got about 95% of global central banks tightening monetary policy right now. So that's a big issue from a liquidity cycle perspective. And then lastly, the positioning cycle in terms of how our investors positioned. On one hand, you have asset or active managers, particularly the hedge fund community. They've sort of delevered and are not as running with the same kind of capital at risk, value at risk that they had been really prior to the year. But you also have this massive passive influence over markets that at any point in time, particularly when the labor market starts to deteriorate, could really come unglued and cause some real significant adverse consequences, just given where household ownership of equities is relative to the historical levels. So we can unpack any of that. I think it's a pretty interesting time to be an investor, pretty interesting time to be a process-oriented investor, because right now, if you don't have a process, particularly a good macro risk management process, you are confused as hell.
Yeah, I mean, even in the active investing area, which is kind of where I live as a swing trader, it has been a rough year. It's been really rough. I typically will trade a nice trending market, buy close to support or buy breakouts, and both of those have been really hard to do in this last couple of months here. What would you say, Darius, is the most important macro factor today that you think active investors should pay attention to?
Yeah, so I mean, it's going to be unfortunately, it's probably pretty obvious, right? It's the reduction in liquidity out of the Fed and the tightening path that the Fed has sort of laid forth for us. One, I think there's kind of two things you could sort of dig into there. One, there's the forward guidance aspect of that and how that's already contributed to some pretty outsized financial tightening, particularly in the credit markets. You've seen a 3 sigma rise in mortgage rates, a 3 sigma rise in corporate credit yields. If you look at the Bloomberg Barclays yield to worst credit statistics index, And so we're already starting to see a lot of that tightening flow through the economy much faster than we would have historically seen, just without in the absence of that forward guidance function. So we are sort of in no man's land as it relates to what the kind of quote unquote long and variable lag is with respect to monetary policy tightening or easing and its impact on the economy and ultimately asset markets. And so I think that's a pretty important kind of thing that investors need to pay attention to, because again, we're obviously going to continue to get tightening, and if inflation continues to surprise to the upside as it has really for the last 6 to 9 months, actually really 11 months now, and almost 12 most likely, we're going to continue to get incremental tightening from a forward guidance perspective, which ultimately means incremental tightening from a realized asset market perspective. The second most important thing, and I would go 1A and 1B here, I wouldn't necessarily go 1 and 2, which is the growth cycle. Right now, we've had this sort of brief respite in what had been a trending cyclical deceleration off the sort of Q2 cycle peak in growth that we observed last year. That was obviously very much aided and abetted by a pretty aggressive fiscal stimulus program. One of many fiscal stimulus programs we were sort of seeing authorized throughout the pandemic. And so now we're kind of on the backside of that, not only just from a base effects perspective, but we're also returning back to potential growth or whatever that looks like on a post-pandemic basis. But we're also in the middle of that. We're getting that fiscal drag component that's obviously likely to continue to push growth lower. Offsetting that, obviously, you continue to have a decent amount of cash savings built up in household balance sheets. We can see that through the flow of funds data. But again, the cash savings tend to be very, very not distributed evenly. It's our estimation that sort of the lower median of households have already burned through a lot of their cash savings and are sort of really kind of eating it from a real income and consumption appetite perspective.
Darius, you mentioned the Federal Reserve a few times.
Mhm.
What role does the Federal Reserve play in markets? You touched on it a bit with injecting liquidity, taking away liquidity. Other than that, what role do they play? And do you think they're doing a good job? And if not, why aren't they?
Yeah, so let's start about what's the Fed's mandate, right? So what the role they play is a little bit different than their mandate, right? Their mandate is to promote maximum and inclusive employment, at least according to them. That and inclusive was added to their implicitly added to their framework going back to the fall of 2020. They're also here to promote price stability, and what that means in terms of their inflation mandate and inflation target is to thereabouts 2% on core PCE with some flexibility to the upside or downside to make up for prior shortfalls or prior runs higher than the target. And ultimately, what that's transitioned to in terms of the Fed's ultimate impact on the economy and asset markets is through what we consider to be their sort of implicit third mandate, and that's the price. That's the sort of financial conditions function to make sure that capital markets are buoyant, not necessarily buoyant, but certainly functioning at a rate that allows the economy to grow and not have to deal with some adverse consequences from a credit and counterparty risk perspective. So the Fed sort of has this sort of kind of tertiary financial stability mandate that in the post-crisis era, in the absence of kind of a buildup in the leverage cycle that could really perpetuate a recession, and certainly in the absence of prior to the last kind of year or so, in the absence of a sustained impulse in inflation that would prevent them from being as easy as they were on a perpetual basis. The financial conditions, the financial stability mandate has really been their driving mandate in terms of how the Fed has interacted with the economy and asset markets. And so as investors, we're all feeling a little awkward right now because it's been quite some time since that hasn't been the case. It's by our estimation that, when the Fed decided to bail out long-term capital management, they had shifted to a sort of financial stability mandate as their primary mandate, and have really been operating under that for the most part, absent a few months here or there, really been operating under that mandate or under that framework since up until this most recent kind of era where the Fed is clearly and overtly focused on containing and quashing inflation at the expense of the economy and asset markets.
When the Fed reacted coming out of the pandemic crisis or that big, downdraft that we had, I've heard some people say, well, if they didn't, real bad things would have happened. Do
Mhm.
you subscribe to that idea that they had to act or else real trouble would have happened? And what is taking them so long or what had been taking them so long to kind of shift their narrative? Because I agree with a lot of those people and they say, look, the Fed needed to step in, and they did it quick, and that was great. But
Hmm.
then they're a little long in the tooth in terms of, to your point, removing some of that liquidity. So why do you think they were so quick to react on one end and so slow on the other?
Yeah, that's a great question. Because I hadn't had anybody, Scott, put it to me that way. Like they're panicking in this direction, but they don't seem to have that same level of panic in the other direction, right? And quite frankly, it comes down to they just got the inflation forecast wrong. I mean, by the way, all economists did, including myself. We certainly thought inflation would be peaking last fall at about a couple hundred basis points lower than it is today. We got this sort of what we would consider to be this fourth wave of inflation that was in large part brought on by the incremental supply chain disruptions stemming from the geopolitical unrest and the sad situation over in Ukraine. So it's not like any of us could have saw that coming, but certainly the Fed could have begun as an Alan Greenspan Fed, and certainly a Paul Volcker Fed would have done. Would have been reading the inflation cycle tea leaves going back to the spring of last year, and really starting to see the likelihood that we were going to get a big wave higher in inflation and start to pull back some of that stimulus. Why were they so late? So let me just go back to the initial part of the question. Why were they so quick to panic in the spring of 2020? There had become, so this was the spring of 2020 was fresh off the kind of blow up in the repo market that we saw in the fall of kind of in the summertime, in the early fall of 2019. And so the Fed had been very sort of keen on understanding, how the financial system works, its impact on the financial system. This is, obviously a series of, information gathered really going back to the Q4 of 18 when the market crashed on, kind of a mismatch between Fed policy and the growth outlook. So ever since that moment, the J. Powell Fed has been sort of trying to gather and learn as much as it can about how these markets actually function, repo, the treasury market, and the impact on the broader sort of financial balance sheet in terms of all these different tools that the Fed is using to drain liquidity or add liquidity. And I think what happened in March of 2020 was the breakdown in the treasury market. We saw real interest rates gap higher on the long end of the treasury curve. We saw a big route, sort of big squeeze higher in the dollar. We saw a lot of the associated counterparty risk measures really blow out in that particular moment. So the Fed, realizing that it's prior mistakes and realizing the kind of ultimate impact it could have on stemming some of that some of those consequences, really kind of stepped up to the plate in a major way. Quite frankly, I would commend them for doing that because, quite frankly, it was a really scary time. Not many of us have lived through a pandemic and a global shutdown. Fast forward to the spring of 2020, when I think, in retrospect, because I didn't hear a lot of people saying it at the time, but certainly in retrospect, the Fed should have begun removing liquidity at that particular juncture, because it had become pretty clear that the U.S. was on the verge of something that looked like a much higher, much above trend inflation inflation impulse. You go back to the Fed, the Treasury authorized, Congress and the Treasury authorized another, let's call it $2 trillion in fiscal stimulus at the time where the economy was already growing above trend, right? So that should have been a trigger for the Fed to say, hey, look, we understand that you have this new maximum, quote unquote, and inclusive, because I think the and inclusive is the reason we're here. We understand that you have this new and inclusive mandate. And what I mean by and inclusive is the Fed pivoted back in the fall of 2020 to adopt a framework around their labor market, sort of their gauging of the labor market conditions, to sort of create additional space for the economy to improve, for what had been historically disaffected groups like females, African Americans, Latinos, those types of groups who've historically seen their unemployment rates decline at a much slower pace, and for and much slower at a much slower rate that we've seen, kind of in post crises or post during recoveries. And so the Fed has effectively said, hey, look, we understand that there's this sort of dynamic going on in the economy. We want to be, quote unquote, woke, and we're going to do something about it by easing more than we otherwise would. Well, guess what? That's why we're here today. It's not the only reason why we're here today, but it's certainly why the Fed is now playing catch up at a pretty aggressive pace.
We've heard the Biden administration talk about the Ukraine as well, and Ukraine having a big impact on inflation. Do you see that in the data?
Yeah, so I mean, you can definitely see that Ukraine. Yes, the quick answer is yes. It's not just geopolitical consequences in Ukraine, but we know you get food inflation at a 12% on a 3-month annualized basis. That's as high as it's been since November 1980, and that's obviously contributing to elevated headline CPI as well. It's 11% on an annualized basis. That's the fastest pace we've seen since September 81. Obviously, the big impulse that we got in energy prices in the month of March is really driving that. It's up right around 64% on a 3-month annualized basis. But that's just headline. It's not just headline. I think the one thing that's sort of kind of missing from the Fed's discussion, and I think we're going to hear a little bit more about this over the coming months, is that, hey, when you kind of peel back the onion on inflation, it's actually not just headline. We actually have a real serious inflation problem here in the U.S. And two statistics I will cite in support of that. If you look at median CPI, which obviously looks at the median inflation rate of all the different things, the many things in the consumer price inflation basket, on a 3-month sour basis, 3-month annualized basis, we're at 6.4%. That's the all-time high in terms of the trending inflation impulse that we've observed in the economy on a median basis. Like more higher than anything we've seen in prior inflation episodes. And if you look at it on a sticky CPI basis, so these are things that tend to have very lagged changes in their prices. The prices tend not to be very volatile. So things like rent, et cetera. Sticky CPI on a 3-month annualized basis at 6.6%. That's the fastest pace we've seen since August of 1990. So if there's anybody at the Fed that still believes, which I don't believe at this point there are, but if there is anyone at the Fed that believes that, hey, this is all headline, we can't do anything about it, they're mistaking. They're misrepresenting the kind of supply and demand imbalances in the economy.
In what aspect of the market now is a safe area? Because we're seeing volatility in all of the asset markets, and even gold, which in my opinion should be rocking right now, is really lagging. So what's a safe area for an investor to look at? Is it just cash? Do we just wait in cash and hope it works out? Or what are you recommending to the people you talk to?
Yeah, so that answer depends on what you do for a living. If you're a professional investor and someone who can't sort of let's call it take their ball and go home by raising a significant amount of cash, taking down your gross and net exposure, or taking down your gross and net exposure, then you're someone who is sort of relegated to playing the sector and style factor battle within the equity and credit markets. Within the equity markets, it's pretty clear that you want to be in defensive, lower beta type names, low beta as a style factor, dividend yields as a style factor, healthcare, consumer staples, sort of triple net REITs, those types of sectors and industry exposures. And obviously on the short side, it's pretty clear anything high beta, anything growth, anything kind of cyclical, with the exception of energy. We would caveat energy's on its own little cycle here, but so it's pretty clear from a dispersion perspective what to do in the equity and credit markets. It's also pretty clear that within the fixed income markets that you're having a lot of I would say it's less clear to do what to do from a dispersion perspective in fixed income markets outside of just being super short duration across the board across all products. We would actually make the case that spread products are to be sold as well, sold on strength as well, because we're certainly heading into we believe that we're heading into a deeper faster deceleration in economic activity. That should weigh on corporate margins and cash flow expectations, et cetera. If, however, you're not a professional investor, so those are the kinds of conversation I'm having with our, what we call our pro-to-pro subscribers. These are hedge fund, mutual fund, RA type investors who need guidance on, hey, I got this egg and it's not going anywhere. So how do I reinvest it, reallocate it? And then there's our sort of retail type subscribers. We have a lot of folks who kind of are native to the crypto space, who subscribe to our macro research. And I tell them the same thing, which is a very different question, a very different answer than I just gave you, which is, if you have the ability to raise cash, go raise cash. Allow yourself to sleep at night. This is I'll quote a stat. When we turned bullish in the fall of 2020, bombastically bullish at that point. I don't think I've ever been as bullish prior to I think 2017 was like the only time I'd been more bullish in my career personally, which was saying, hey, look, there are 5 things that are about to happen, at least according to our models at the time. This is October 2020. That are about to happen that almost never happened at the same time. Growth's going to be accelerating. Inflation is going to be accelerating. Corporate profit growth is going to be accelerating. Margins will be expansion, all that good stuff in that bucket. But then you also going to have aggressive monetary easing and aggressive fiscal easing. There've been like 10 quarters, there've been 10 quarters prior to that moment since 1960 that where all those things have happened at the same time. And obviously, you imagine, the annualized returns on things like the S&P are extremely high. And I'm like, hey, we're about to get like 3 of these quarters back to back to back to back. Q4 of 2020 and obviously first half of 2021. And so it's no surprise from our perspective, that we saw such aggressive price appreciation in pretty much every financial asset. If you couldn't tie it down with the ribbon, then it was floating away from a price perspective. Well, fast forward to today, we're effectively on the precipice of seeing the exact same dynamic, but in reverse. Growth will be decelerating. Inflation's likely peaking. So by the time we get into the third quarter this year, we'll have inflation decelerating. We'll have corporate profit growth and margins compressing. We'll have aggressive monetary tightening, aggressive fiscal tightening. It's literally the exact opposite scenario that created bubble price charts for every risk asset, known to man. And so the expectation that we're going to somehow survive the opposite of creating bubble price charts for every risk asset known to man is it's a fallacy, in my opinion. And so understanding that it's a fallacy, the most natural conclusion would be to say, hey, look, if you don't want to lose your stress over trying to sort of trade every single wiggle in the market, because most wiggles are going to be, angled down, unless you have the ability to generate returns consistently on the short side, you probably do well just to book your gains and give yourself some time and breathing room, opportunity to wait and go buy assets that you like back at a lower price. It's not, a lot of money, a lot of capital has been lost by short sellers in bear markets. That's when you get the largest sort of deviations to the upside typically in terms of squeeze risk. So it's hard managing bear markets.
You mentioned Bitcoin and crypto. How do macro headwinds drive the correlation between the stock market and digital assets? Because there was a narrative, it's an inflation hedge. That turned out not to be true. So what's your view on that?
Yeah, so it's a risk asset. So let's start with part of the reason Bitcoin has become more and more correlated. I want to say right now, if you look at it on a trailing 3-month basis, the correlation between that and the NASDAQ somewhere around all-time high or just thereabouts. The reason it's become so tethered and so correlated to these traditional financial assets is for two reasons. One, institutional adoption. Institutions, buy side, they have, very systematic risk management frameworks. If they have any capital at risk, you're not able to raise money in the last 10 years or so without all that institutionalized kind of risk management. And the reality is, if you have an asset that is as volatile as Bitcoin, it's going to be subject to some very strict risk management controls. Not to mention, as it continues to get incrementally correlated, you're going to have to continue to reduce the position size because the covariance between that and everything else in your portfolio continues to rise. And so just from an institutional risk management perspective alone, there's now kind of an underlying sell bid in Bitcoin until this sort of volatility breaks down. And then there's also sort of just broader human adoption, right? Mom and pop in Ecuador, transitioning their life savings to Bitcoin and out of whatever currency Ecuador probably trades. I would imagine it's probably the dollar if I had to guess, but those types of stories. Well, if the global growth rate slows down and the income generation of those households and businesses slows down, particularly on a real basis, then there's less money to go into this ecosystem and capitalize, the value of these coins and these I don't want to say securities, but tokens. And so that's part of the reason why we're seeing, Bitcoin, Ethereum, all these other digital assets really struggle in this particular moment, because the bigger it gets, the more likely it is a macro trade. And it's always been a macro trade. I mean, right? You heard the story from day one in Bitcoin. It's central bank balance sheet expansion, it's inflation hedge, it's this, it's that. And all those things were eminently forecastable and modelable macro risks for anybody who's paying attention and doing the work. We all were in traditional finance space. We just weren't applying it to digital assets. Well, one thing we are very keen on at 42 Macro is weaving the digital asset ecosystem into our broader macro risk management framework to help investors understand kind of the types of risks they should be taking in the crypto space.
Darius, you mentioned current market conditions and the slowdown in growth. What gets us out of this scenario that we're in right now to a much more trending and some may say comfortable market condition?
Yeah, that's a great question. So typically what you're looking for, if you're in a bear market or something that looks like a bear market, is obviously you want to be getting close to the point where either the growth slowdown is fully priced in. I think we're way too soon in this process for that to be the case. We're still comfortably above trend. We have to go to below trend, at least according to our models, over the next 12 months. So we're nowhere near that check mark, that check box. So then you put the onus on the Fed. Okay, will the Fed pivot dovishly and allow that process of transitioning to a slower economy? Will it sort of offset that by balance sheet expansion, liquidity provision? Well, that seems to be the case. That's very unlikely to be the case. If anything, the Fed is pro-cyclically tightening. As the economy is slowing, the Fed is incrementally stepping on the brakes. And so we don't think that that risk, that bullish risk, that upside risk from a Fed pivot is something that should be priced into markets at the near term as well. So you kind of think about, okay, well, what else could cause a positive outcome in markets? Well, the geopolitical resolution, although I'm not sure I think we're past the point of getting a quote unquote resolution. And what I mean by quote unquote resolution is the sanctions aren't going anywhere. Both the European Union and the US have accused Russia of committing war crimes. There's going to be a long tail associated with the prosecution of those war crimes. And until we figure out who's done what and who's responsible for what, it's very unlikely we see a removal of sanctions, right? It's where, there needs to be some sort of kind of, retribution, if you will, for alleged war crimes. And so that kind of leaves you with okay, what happens on the inflation front? It's not our view that inflation is set up to collapse. If anything, I think the risk that inflation continues to surprise investors to the upside is actually quite high, at least according to our models, just based on the stochastic momentum in the time series. I mean, you're continuing to build momentum to the upside across a variety of inflation metrics. And so this sort of consensus view that inflation is peaking here, and it may very well peak on a year-over-year rate of change basis because the base effects start to really kick in, particularly in the month of April. But I don't think that matters. I think what really matters is, okay, what is the trending underlying rate of inflation? And right now it's somewhere around 6 to 7% on a median and sticky basis, somewhere around 11% on a headline basis, and around 6% on a core basis. Those numbers are all significantly higher than the Fed's 2.5% inflation target. And so that to me is that's the issue with inflation. But if for whatever reason, we see, again, I don't think this is a possibility, the highest probability, but if it's a possibility, I'll say it out loud. If we, for whatever reason, saw inflation sort of crash over the next 2 to 3 months, what you're likely to see is an inflation of real incomes as a function of that. And then you're likely to see sort of a much more kind of tepid pace of deceleration in the economy. It's going to be an economy that looks to be sort of, kind of cooling on an organic kind of welcome basis. Like, hey, look, this is an economy that was overheating. It's now cooling. It's cooling at a reasonable pace that we can price in, kind of a positive market outcome. In our nomenclature from a quantitative perspective, we call that a zero sigma delta growth slowdown. And so all that means is the speed of the change, the deltas on the differentials on growth are zero sigma relative to the trailing 3-year sample. That usually has a positive 3%, or at least if you look at our backtest window, it's between January 1998 and present, but we also loop in the inflation episode of the late 60s through the early 80s. And so we have those two samples to anchor on in terms of our backtest. Historically, a zero sigma delta growth slowdown is something like a 3% annualized return on the S&P. So that's nothing. That's a yawn. That's who cares if we're slowing at that pace. What matters, and what I think will matter to asset markets in the second half of this year, is we're likely to head into what we call a 2 sigma delta growth slowdown. And that's a minus 29% annualized pace, or annualized decline in the S&P 500. So, that to me is the big issue. It's, hey, look, it's not just that we're slowing, it's that we could potentially be slowing at a much faster pace. And oh, by the way, there's going to come to a point in time, if that's the case, where it looks like the Fed is out to lunch as the economy is slowing, much like it did in Q4 of 18, right? That's exactly what happened in Q4 18. We're a long ways away from neutral, And guess what? No. The economy is really starting to slow here. Repo market's starting to show signs of weakness. And you're over here talking about we're a long ways away from neutral. Well, let me crash and get your attention so you can pivot. And I think that's exactly what asset markets are setting up to do.
What about commodities, Darius? Commodity and the commodity trade has been hot over the last couple of months. How do you see this playing out for the next, foreseeable future? I don't want you to predict years from now, obviously. No one can do that, as we know. But in the short term, if I look at the DBC chart, it's still in a nice uptrend right now.
Oh, yeah, absolutely. Great call out on DBC there. So we've been bullish commodities, but particularly in the energy and ag space. And the reason we were focused so much on energy and ag is because of the inelasticity of the supply demand curves. We're something like a base metal, which have done well. They've done well this year, or at least a lot of them have up until recent weeks. We've seen those demand curves tend to be a lot more elastic and a lot more sensitive to the growth outlook. And so clearly, what's going on in China from a COVID response perspective, but also just in terms of what we have forecasted for the global economy, the outlook for base metals in particular is not particularly positive, certainly within relative to other pockets of the commodity space. But, we've liked commodity space more than equities, in the last few months. And the reason we say that is because, if we're wrong on the bearish outlook for growth, Well, guess what? Well, we still are long risk some risk assets and have an upside, have, some opportunity to participate in price appreciation associated with that, right? Like if we don't get the demand destruction that we ultimately inevitably do see coming, and so it puts a lot of onus on us to kind of book the trade at a reasonable price before that occurs. But if we don't see that demand destruction, then guess what? We're long things that are going to go up and be a beneficiary of tight supplies and rising demand. Stocks will obviously do well in that particular environment as well, but I believe the commodities give you a better setup from there, because again, if we do see something that looks like a geopolitical shock, or kind of a fight for security, if you will, for crude oil storage, energy storage, food, grain supplies, that could very easily materialize while growth is slowing. And so you got to get the best of both worlds from a commodity market perspective, which is you get protection on one hand from the meltdown in the fixed income market in terms of reallocating those assets. You get protection on the other hand from potential geopolitical in terms of securing physical bearers of commodities and stockpiles of different cereals and grains, et cetera. And then you also get the potential risk that, hey, what if I'm wrong on the growth slowdown and everything's going to wind up being fine, and you still get that upside demand kicker on commodities. So I think you have a lot more ways to win being long commodities relative to financial assets.
Darius, could you touch a little on the sanctions in Russia and how they have affected the ruble? We saw them close their markets for a while, and then the ruble dropped, and then the ruble kind of came back up. And I was talking to someone over the week. They were like, "Well, I don't know why it came back up. Like, what happened exactly?" And do you think in the short term this is bad for Russia, good for Russia, bad for the world? How do you see this playing out in terms of all the sanctions against Russia versus, I guess, the rest of the world?
So Russia's, I mean, if they want to say it's like the 11th or 12th largest economy, it's not big in terms of its demand impact on the world. Like the world doesn't sell Russia a lot of stuff, right? They don't have a big consumption economy, but what they do are they are a meaningful, obviously export of natural resources. I want to say the world's number 2 largest export of crude oil, nat gas, and coal, and number 1 I think in coal, number 2 or 3 in steel, things of that nature. So they matter from the perspective of the physical goods economy, the manufacturing economy, keeping your heat warm or home warm in the wintertime, particularly for large parts of Europe. So that stuff matters. And, part of the reason we've seen the Russian ruble recover, as, even amid these sanctions is one, the sanctions have very conspicuously left off, at least with respect to Europe, the kind of the key core, exports of the Russian economy. So the fact that we're not, bringing in crude oil, nat gas, really folding them into the sanctions on a meaningful way, tells you that a lot of the pain and weakness that we saw initially on the outset of the ruble was kind of overblown and overdone with respect to that. And secondarily, you also likely have a lot of capital controls being instituted in Russia. I haven't had time to kind of dig into Russia and, from that perspective, but I would imagine that the central bank there, the Treasury authority there, the fiscal authority there, are sort of making it very difficult for Russian consumers and businesses to get their money out into different asset classes, and more importantly, probably making it quite onerous for Russian oligarchs to keep their money abroad in different places. And so I'm guessing we're seeing some sort of regulation and rules being put in place for everyone to support the war effort back home in Russia.
Darius, even in this conversation, I can tell the scope of everything that you need to look at and follow. I mean, it has to be hard. It has to be hard to follow so many, because you're looking at the whole world, then you're looking at America, and then you're looking at all the different things, CPI, et cetera, et cetera. So if someone is coming to you and interested in learning about macro, where do you point them to even get started?
Yeah, that's a great question. So the thing that helps us out and helps us really kind of organize our thoughts and really find the right things to research and focus on is really through our grid regime framework. The regime segmentation really allows us to sort of kind of winsorize our sample of potential outcomes into something that's a lot more manageable, that we need to sort of get updates and checkups at the margins on. And so when I say grid regime, that's just our 4-quadrant regime-based framework, where G stands for Goldilocks. That's where growth is accelerating and inflation is decelerating. That tends to be very positive for asset markets, particularly risk assets. R stands for reflation. That's where growth and inflation impulses are both positive. That tends to be very negative for bonds, positive for stocks, obviously, and commodities. Inflation, that's the I there in the grid. That's where growth's decelerating and inflation's accelerating. Tends to be negative for risk assets, with the exception of commodities. And then lastly, you tend to have And D is for deflation. That's where growth and inflation are decelerating simultaneously. That's where you get the outsized excess returns and the dollar, treasury bonds, et cetera, gold, things of that nature. And so that framework, being able to sort of, forecast, build models to forecast growth and inflation in all these various economies and ultimately understand where they've been and where they're likely headed to in that framework speeds up the entire process of understanding what matters, right? If we know we're heading into this particular grid regime, well, here's how asset markets have historically performed in this grid regime. Here's the dispersion, likely dispersion you should anticipate. Here's the volatility, covariance across the different asset exposures. So that really speeds up the process of helping investors construct thoughtful, balanced portfolios that are designed to take advantage of some of these macro risks, right? There's two types of portfolios in the world. There's portfolios getting shocked by macro risks, and there's portfolios that are prepared and, sort of taking advantage of changes in these macro risks. And so that's what we try to do, is help investors build the latter style of portfolio. But you're right; it's a full-time job to know all this stuff. It's a grind, but I'm passionate about it. I couldn't even imagine doing anything else. It's something that I think I was put on earth to do.
What are some must-read books for investors that you lean into to really help you tighten the screws in your trading and really kind of strengthen the foundation of what you do?
Yeah, absolutely. So my number one favorite book, I think it's the number one book I tell every intern, mentor I ever talk to, go read this book. It should be the first book you read if you're walking into the financial services industry, which is Thinking Fast and Slow by Danny Kahneman and Amos Tversky. That book explains everything you see on your screen from a behavioral standpoint, both to the meme side, to the institutional finance side, the CYA side of it all. Like, there's so much in that book that once you learn, you can't unlearn from a human behavioral standpoint in terms of how human beings interact with the economy and asset markets. So that to me is number one. In fact, I highly recommend you read that every few years. I've read it 3 times already. Number 2 would be kind of The Misbehavior of Markets. Benoit Mandelbrot, godfather of fractal math, sort of really kind of gives you kind of an eye-opening kind of introduction to sort of the relationship between price and volatility in asset markets, and ultimately how to sort of weaponize volatility to actually, kind of predict price and to kind of fold that into your risk management overlay. So that's a super important book as well, because I think a lot of what we do from a quantitative signaling perspective really kind of is born out of a lot of those learnings. And it's not just us. I think a lot of investors have found a lot of value in Mandelbrot's work. And then lastly, as someone I strive a lot of kind of value and thought leadership too, is Ray Dalio over at Bridgewater. You say what you want about him at this point, but I don't think anybody gets anything about his ability to teach and educate us on some of these core first principles type things that really drive the economy and asset markets in the long-term debt cycle, changing world order. But my kind of introduction to Dalio came all the way back in 2009, 2010. I think I started in the business back in 2009. Which is kind of getting my hands on their white paper for the all-weather framework and understanding, hey, the power of regime segmentation from an asset allocation and portfolio construction perspective. So, kind of reading everything Ray Dalio has written since has really been beneficial for my career and beneficial for our clients.
Do you have any other resources that you like, maybe on a daily basis, a few websites or things that you're checking out, to kind of get yourself ready for the day?
Yeah, absolutely. So I got some buddies over at Spot Gamma. My friend Brick Kachuba, Imran Laka over at Options Insight. These guys do fantastic work. Alfonso Pecatiello over at the Macro Compass, Andreas Steno Larson. These are guys that sort of I kind of do interact with and do some work with just on my platform and on their platforms. And these guys have real great orthogonal type resources that kind of help me see the world from a different lens, or kind of see through the world through the different lens that I'm currently kind of focused on. A lot of their stuff is really dealt in the vol space, or kind of in some of the esoteric parts of the fixed income market. So that's really super helpful stuff is there. But there's also podcasts too. I listen to a bunch of podcasts. Love Forward Guidance out of my man Jack Farley. I think he's done a really fantastic job of in terms of introducing a brand new podcast. Obviously, shows like yours are very helpful as well. So yeah, I mean, there's a bevy of resources. Like I'm so impressed and proud of where kind of finance has evolved in recent years. I mean, a lot of the stuff you see on FinTwit, these are the conversations I was having with, macro hedge funds, 5, 6, 7 years ago, that would never escape the room. But now you just see it like every other day, every other week on FinTwit, there's a deep dive discussion, about some esoteric pocket of the economy or global financial system. And there's so much information and clarity being provided and thought leadership being provided. So I'm very grateful to be part of that. I'm very grateful to take advantage of it.
Well, and we're very grateful as viewers to watch contributions like what you do. You know, you release your daily macro minute, and you're always putting stuff on Twitter, and so you're contributing to to these great conversations. So thank
Thank
you for all of that.
Appreciate you, Scott. Thank you, man.
What are some misnomers, Darius, about macro investing that you wish people knew?
Ooh, that's a good question. I would say the number one thing that I think investors get right or get wrong that don't understand macro is sort of making their portfolio reflect a singular macro view. Like at all times, there's always a range of probable outcomes. And now sometimes the range is very narrow. The distribution has a significant amount of excess kurtosis. Other times you can have a very flat leptochotic distribution where, there's a lot of stuff that could happen on the tails that, that has a much higher probability that you need to allocate resources to protect yourself against. And so one, understanding that the shape of the distribution of probable outcomes changes over time and is a function of the likely changes in path for growth and inflation and the policy reaction function therein, but also just making sure that your portfolio is acknowledging of that dynamic. If you're bullish, you don't want to be 100% long, whatever you're bullish on, or if you're bearish, you don't want to be 100% bearish on whatever you're bearish on. The more thoughtful thing to do, and the reason why professional investors consistently outperform and consistently have better sort of risk-adjusted returns than regular, retail investors or kind of mom and pop investors is the fact that they understand that there's a distribution of outcomes. And so they're layering their bets, not just across different themes. Our themes would be, Goldilocks, reflation, inflation, deflation. Someone else's theme could be China tech consumer story versus, U.S. autos and housing. They're layering their bets across themes, but they're also layering their bets across durations. Hey, I got these things that I'm long and short that I think should, I can monetize over the next 2 to 3 months. Here, these are things that I expect to continue building positions in, that if these things go my way, I'm probably going to get an incrementally better price to buy into for kind of a 6 to 9 month setup, or 9 to 12 month setup. So it's understanding that, hey, look, you don't have to be in one singular bet. You don't have to be operating in just one singular duration in order to make money. In fact, you're probably going to do a better job if you don't do those things.
Is macro investing mostly about broad sector bets or ETFs, or do you ever look at individual stocks?
You can apply macro to individual stocks. I mean, particularly some of these large mega cap stocks that have become real indicative of the broader macroeconomic cycle. They're obviously secular growers, but there's a point you get to a point where you're so big that even though you might be a secular grower, you're still going to be very much tethered to the broader economic and financial market cycle. I think of Netflix very much as a function of that. I think of Google, these types of companies, Facebook, obviously, they're tethered to the advertising cycle. Netflix is tethered to, the income cycle and people's willingness to spend, 12, 13, 14, $15 on, one of their 10, streaming services. And so, there's, you get to a point where you're so big that you are the economy. And so I do believe that is an issue with some of these stocks. But broadly speaking, you can try to do those things. But I think one of the things that I think I would caution against as an investor is assuming that you can apply one framework for every single market situation, every single trading setup. That's just not the case. You're a swing trader. I know for a fact that you'll back me up on that. It's not always the same setup. You not always use the same models and the same tools. What you're trying to do, obviously, is find a tool or a set of tools that is pretty consistent in helping you generate returns, and relying on that, and more importantly, evolving that tool as you sort of get information along the way, because obviously you gotta have false positives and things of that nature.
For long-term investing, how do you go about recommending portfolio construction? So I don't need individual, I'm not looking for you to share your secret sauce with us here today, but just in general, how do you recommend people come up with a balanced portfolio for broad market conditions?
Yeah, so it starts with understanding where you are today, how long you're going to be in this type of environment, this type of regime from a growth, inflation, policy, and positioning standpoint. Those are what I would consider to be the four principal components of macro risk management. Then where are you going to be tomorrow, from a growth, inflation, policy, and positioning standpoint. And then understanding the sort of relative, risk and return, or risk and reward for the different asset classes and the exposures within those different asset classes, and how those risk and reward values are likely to change as you go from regime A into regime B. There's a lot of math and work that goes into that. from an expected return, expected percent positive ratio, expected volatility, expected covariance, kind of standpoint. But we do all that work for our subscribers and clients at 42 Macro. So I would highly recommend, folks come check us out. You don't need to be a millionaire, a gazillionaire, or, running a big firm or at a big hedge fund to subscribe and get a lot of value from our resources. Quite frankly, I think, the less resources you have as an investor, the more likely it is you can get value from what it is that we're putting out at a very reasonable price.
Why do you think you're so passionate about this type of investing? Because there are so many different types of ways to make money in the stock market. Why do you think, for you personally, this is kind of what you're most passionate about?
To be honest with you, this is what clicked in my head. When I first started in the business, I was a retail analyst covering, retail stocks like, Walmart, et cetera. And, I did that for about 6, 9 months. And, I didn't hate it, but I didn't love it. It wasn't as, putting together the puzzle wasn't as exciting. When you put together a macro puzzle, it's like having like 1,000-piece puzzle on a small table, right? And it's, just you got to pick up all these different pieces and find and figure out how they fit together, and ultimately you generate and create a framework that allows you to do that at a high level on a consistently iterative basis. And when I did that with companies, it was like, this is a 25-piece puzzle or 50-piece puzzle on a big table. Like, it's a lot easier to put together the pieces of the puzzle. Now, that doesn't mean that picking stocks is easy. I think picking stocks is extremely difficult, because one thing that is more of a factor in stock picking than it is in broader macro trends is, sentiment and what's the buy side think, what's the sell side think, what's the whisper number, who thinks what, who just sold what, like that stuff matters a lot more in stock picking. And I think that's probably more than half of the job. But the easy half of the job, which is just, hey, they're going to give you all the data, you put it all into the spreadsheet, it's going to give you a valuation of the company. It's pretty easy that part. So I didn't get a lot of value out of that stuff, but I did get a lot of value in sort of macro, and particularly macro risk management, because it wasn't this sort of, it was kind of the Wild West when we were really kind of, setting out to do that, to build, the framework that I built at Hedgeye. And then obviously we built, somewhat of a similar framework here at 42 Macro, which is, hey, look, this was, oh my God, like only the hallowed halls of places like Bridgewater, we're kind of doing this. And you figure out that, hey, not everyone, everyone's doing some version of this. If you look at some of the major hedge funds across Wall Street, and obviously the sell side as well. But at the time where I was like, hey, look, this is going to allow me to put together that puzzle a lot easier, a lot faster, a lot more iteratively. So that's just how it clicked for me. And then lo and behold, everyone turns out everyone's using some version of regime segmentation.
Darius, you work pro to pro. That's one of the major services that you offer at 42 Macro. What are some of the most common questions you're getting lately from other pros?
Yeah. So, I mean, normally that's a very narrow distribution depending on what's recently happened in the markets. This year, it's been all over the place, man. I mean, I've been getting questions on, like what's QT going to look like? Is QT going to bite? Is kind of the number one question I'm getting from a pocket of our clients. And what I mean by that is sort of, in terms of how we calculate the Fed's liquidity provision for asset markets in the economy, we factor in the Fed's balance sheet, but also the Treasury general account balance. And sometimes those things are moving, in a way that both promotes liquidity provision. Sometimes they're moving in both in a way that promotes removing liquidity from the economy and asset markets. And sometimes they're kind of going in opposite directions, and you don't really know what to make of it. And it's like, there's all these kind of moving levers that both authorities could pull to change the pace and shape of the balance sheet and the Treasury general account balance. So right now, there's kind of this awkward setup where if they wanted quantitative tightening to be very kind of toothless, Janet Yellen could do that. I mean, the Treasury general account balance is very inflated right now at $900 billion. She could actually drain that throughout the balance of the year and not issue any incremental net new paper and allow quantitative easing to be just kind of passively, easily absorbed by the financial system. Now, that doesn't make a tremendous amount of sense to me in terms of our the lack of progress that they've made in terms of beating down the inflation dragon, but it's a risk, and it'd be a very extremely positive risk for asset markets. And so that's the kind of one thing we've been talking about from a plumbing perspective. From a growth perspective, I think the number one thing I've been having conversations about is the upside risk to growth over the near term. As everyone's sort of focused on the downside risk to growth over the near term, but one thing that the institutional investors that I talk to, and certainly I myself haven't lost sight of, is the fact that, hey, look, the yield curve inverted, but then it's steepened massively. And I don't hear anybody talking about how much it's steepened, right? And so did the yield curve kind of get too far ahead of itself in terms of predicting and projecting a growth slowdown? Maybe this sort of concept of, this sort of excess savings, if you will. And again, we think the excess savings, to the extent that they exist, which we can still observe it, is largely concentrated in the upper income cohorts. And so could that upper income cohort really come save the day from a growth perspective over the next few quarters, while inflation kind of grinds lower into the back end of the year? That is a legitimate possibility. Again, I don't think it's the modal outcome. Our models are suggesting that's not the modal outcome, but it's a legitimate possibility. So I'm having those kinds of conversations. When we're talking to institutional investors understand the kind of the baseline. Generally speaking, I spend most of my time talking about the risk to the outlook when I'm in those meetings.
Talk to me a little bit about the yield curve. I've heard more about the yield, the 2-year and the 10-year. What are these exactly? Why do they matter? And why is an inversion something that investors should be concerned about?
Yeah, so I mean, the yield curve is as historically has been one of the best predictors of recession in the economy. And typically, what happens is you get an inversion in the yield curve, and that typically precedes. And what I mean by yield curve is the spread of the yield of the 10-year Treasury yield minus the yield on the 2-year Treasury yield. That inversion typically is a sort of longer lead time inversion. You typically wind up in recession somewhere between 12 and 24 months after that persistent inversion in the yield curve. There's also other yield curves. There's the 5s, 30s that tends to be kind of what's inflation expectations relative to terminal expectation on policy. There's the 10s, 3-month bill yield, 10-year yield minus 3-month bill yield. When that goes inverted, you typically are in a recession or some very close to a recession. So there's all these different sort of term premiums across the Treasury market that give investors kind of that send a signal, if you will, back to the Fed, back to the broader economy, that something might be very right if they have a very steep, positively upward sloping yield curve and a bear steepener, or something could be very wrong if a bear flattener, or even worse, a bull flattener is telling you that there's some deflationary pressure. So investors like myself, economists, probably policymakers, we're all watching the slope and shape and changes in the yield curve as a signal from the bond market that, okay, XYZ is priced in, and then it's either changing at the margin or getting stronger.
Wow, Darius, we have covered a lot here today, and I think this is going to be one of those interviews people have to watch over and over, just to soak in all of the good stuff that you've shared with us. How can people find you, get in touch with you, and connect?
Oh, absolutely. I'm so excited. Really, thank you for having me on. This is a wonderful discussion. I always like getting back to the basics. I feel like I've been blessed with the ability to teach some of these advanced concepts. So I'm going to definitely do what I can to share my knowledge with the community. So come check me out. We're at 42 Macro, my partners and I, and then I'm on Twitter at 42 Macro Dale, DDALE. Pretty prolific there as well. So come check us out.
Awesome. Thank you very much for your time, Darius. I appreciate you. Appreciate the work that you put out. And like I said, I'm a huge fan. So this has been a fantastic day for me. So thank you.
Appreciate you, brother. Thank you so much for having me. I'll catch you back next time.
From the bottom, ain't no half stepping. I'm the dog, I made it through so they don't ask questions. Long Beach, and it ain't no half repping. Once a dog, always a dog, so they don't ask questions.